A 67-year-old woman from Ohio sat across from her financial counselor and listened as he explained something she had never been told before. She had claimed Social Security at 62. She had worked part-time at a grocery store for 3 years after claiming, and she had never checked her earnings record, not once, in 35 years of working. In that single meeting, she discovered she had lost over $112,000 in lifetime benefits she was fully entitled to and would never get back. She is not alone. Every single day, thousands of Americans retire and walk straight into Social Security traps that are completely avoidable. These are not complicated loopholes or tricks hidden in fine print. These are well-documented mistakes that the Social Security Administration itself has flagged, and yet millions of seniors continue to make them. Today we are going to walk through 5 of the most costly Social Security mistakes destroying retirements across America right now. If you are already retired, if you are approaching retirement, or if you have a parent or spouse who depends on Social Security income, stay with us until the end, because what you hear in the next few minutes could be worth tens of thousands of dollars. Let us start with the mistake that affects more Americans than any other. Mistake number 1. Claiming too early. A 62-year-old man from Georgia named Raymond had worked in logistics his entire life. His body was tired, his back hurt, and when Social Security told him he was eligible to claim benefits, he signed up within the week. He figured the money was his, he had earned it, and there was no reason to wait. What Raymond did not understand was that his full retirement age was 67, not 62. By claiming 5 years early, his monthly benefit was permanently reduced by 30%, not temporarily reduced, permanently. If Raymond's benefit at his full retirement age would have been $2,000 per month, he locked in $1,400 per month instead. Over 20 years of retirement, that difference adds up to $104,000 in lost income. And if Raymond lives into his late 80s, a very real possibility today, the loss grows even larger. Here is the math according to the Social Security Administration directly. If you were born in 1960 or later, your full retirement age is 67. Claiming at 62 means a permanent reduction of up to 30% of your benefit. Claiming at 64 means a reduction of roughly 20%. Even claiming at 66 still cuts your benefit by about 6.7% compared to waiting until 67. But it goes the other way too. For every year you delay past your full retirement age, up to age 70, Social Security pays you an additional 8% per year in what are called delayed retirement credits. That means if your full retirement age benefit is $2,000 a month, waiting until 70 gives you $2,480 per month instead. Over a 20-year retirement, the person who waited until 70 collects more than $115,000 more than the person who claimed at 62, even accounting for the years they waited. Now, claiming early is not always wrong. People with serious health conditions or no other income source may have no choice, but claiming early without understanding the consequences is a mistake that cannot be undone. Raymond cannot go back. He is locked into $1,400 a month for the rest of his life. Think carefully. Wait if you can. Those extra years of patience are worth real money. Mistake number 2. Not understanding spousal benefits. A woman named Carol from Arizona spent 28 years raising her children and supporting her husband's career. She worked part-time here and there but never built up a substantial earnings record of her own. When her husband retired and claimed Social Security, Carol assumed she would just receive something small based on her own limited work history. She never asked about spousal benefits. She collected her own small benefit, around $420 a month, for 4 years before a neighbor mentioned the spousal benefit rule at a community center lunch. Carol had been leaving money on the table the entire time. Here is what the Social Security Administration actually allows. If you are married and your own benefit is smaller than what you would receive as a spouse, you are entitled to up to 50% of your spouse's full retirement age benefit. In Carol's case, her husband's full retirement age benefit was $2,600 per month. 50% of that is $1,300 per month. Carol had been collecting $420 when she could have been collecting $1,300. That is an $880 per month difference. Over the 4 years she missed, Carol lost more than $42,000. Once she corrected the record, her benefits increased going forward, but those 4 years were gone. This rule also applies to divorced spouses. If you were married for at least 10 years and are currently unmarried, you may be entitled to spousal benefits based on your ex-spouse's record, even if they have remarried. Your claim does not reduce what they receive. It is a separate entitlement. Widows and widowers have additional protections, too. A surviving spouse can claim survivor benefits as early as age 60, and those benefits can be up to 100% of what your deceased spouse was receiving. These rules are real. They are established in law, and millions of Americans, particularly women who spent years outside the workforce, are not using them. Do not be Carol. Look up your spousal benefit options at sa.gov before you file. Mistake number 3. Working while collecting before full retirement. Age: a 63-year-old man from Texas named Earl retired from his job at a manufacturing plant and immediately started collecting Social Security. Within a few months, he got restless and went back to work part-time at a hardware store, earning about $30,000 a year. Nobody warned him about the earnings limit. In 2024, if you collect Social Security before your full retirement age, and you earn more than $22,320 per year from work, Social Security withholds 1 in benefits for every 2 you earn above that threshold. Earl earned $30,000. That is $7,680 above the limit. Social Security withheld $3,840 from his benefits that year, nearly 3 months of payments gone. He was furious when he found out. And here is the part that stings even more. In the year you actually reach your full retirement age, the limit rises to $59,520, and the reduction drops to 1 withheld for every 3 over the limit. The moment you pass your full retirement age entirely, the earnings limit disappears. You can earn $1 million and it will not touch your Social Security. But in those months and years before full retirement age, working without knowing the rules can quietly drain your benefit payments without you even noticing until the letter arrives. To be clear, the withheld money is not completely lost. The SSA recalculates your benefit upward when you reach full retirement age to account for the months it was withheld. But that recalculation takes time to pay back, and, depending on how long you live, you may not fully recover what was taken. Earl could have avoided every bit of this by simply waiting to claim benefits until he stopped working, or until he reached full retirement age. He did not, and that year cost him nearly $4,000 in benefits he should have received. Know the earnings limits. Know your full retirement age, and if you plan to keep working, think hard before you start claiming early. Before we get into mistake number 4, I want to take a quick moment to talk about this channel. If what you have heard so far has surprised you, even a little, then Retirement Today was made for you. This is one of the very few YouTube channels out there completely dedicated to retirement insight for Americans who are in or approaching retirement. We cover Social Security, Medicare, taxes, inflation, income strategies, and everything else that affects your financial security in retirement. We do not sell products. We do not have sponsors pushing you toward anything. We just research the facts and bring them to you clearly and honestly every single week. If you are not subscribed yet, please hit that subscribe button right now and tap the bell so you are notified every time we release a new video. It is free, it takes 5 seconds, and the information we share could genuinely change the outcome of your retirement. Now back to the mistakes that are costing retirees real money. Mistake number 4. Not accounting for taxes on Social Security benefits. A retired school teacher named Margaret from Pennsylvania had budgeted her retirement carefully. She was receiving $1,900 a month in Social Security and had a small pension of $1,100 a month. Combined, $3,000 a month felt manageable. Then tax season arrived. Margaret had no idea that Social Security benefits can be taxable. She believed, as many retirees do, that Social Security was something she had paid into her whole life and would receive tax-free. That is not how it works. According to the IRS, Social Security benefits become taxable based on what is called combined income, which is your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefits added together. If your combined income as a single filer is between $25,000 and $34,000, up to 50% of your Social Security benefits may be subject to federal income tax. If your combined income exceeds $34,000, up to 85% of your benefits may be taxable. For married couples filing jointly, those thresholds are $32,000 to $44,000 for the 50% level, and above $44,000 for the 85% level. Margaret's combined income with her pension put her well above the $34,000 threshold. She owed federal income tax on 85% of her Social Security income that year, a bill she had never planned for and had no withholding setup to cover. The surprise tax bill forced her to pull from her savings earlier than she had planned, disrupting her entire retirement timeline. And it is not just federal taxes. 13 states also tax Social Security benefits to varying degrees, so depending on where you live, the hit can be even larger. The solution is not complicated, but it requires planning. You can ask Social Security to withhold federal taxes directly from your monthly payments by filing a Form W-4V, which you can download from sa.gov or irs.gov. Withholding options are 7%, 10%, 12%, or 22% of your benefit. Choosing the right amount with the help of a tax professional can prevent Margaret's situation from happening to you. Do not let a tax surprise drain savings you spent decades building. Mistake number 5. Missing the earnings. Record correction. Window. A retired warehouse worker named James from Michigan spent 40 years paying into Social Security. He never questioned whether the SSA had recorded all of those earnings correctly. Why would he? He had always paid his taxes and assumed the government had kept accurate records. When James finally created an online account at sa.gov and reviewed his Social Security statement for the first time, he discovered something alarming. An entire year of earnings from the late 1980s was missing from his record entirely. That was a year when he had earned over $34,000. It had simply not been recorded. He contacted the Social Security Administration and worked to correct it. But the process required him to locate W-2 forms and tax records from over 30 years ago, documents that took months to gather. Your Social Security benefit is calculated based on your 35 highest earning years. If even one or two of those years are missing or underreported due to an employer error, a clerical mistake, or a data entry problem, your benefit will be lower than it should be, and you may never know unless you check. Errors in Social Security earnings records are more common than most people think. While the Social Security Administration does not publish a specific error rate, individual cases of missing or underreported wages appear regularly, particularly for workers who changed jobs frequently, worked for small employers, or had self-employment income earlier in their careers. The good news is that you can review your complete earnings history for free at sa.gov by creating a My Social Security account. It takes about 10 minutes to set up, and you can see every year the SSA has on file for you. If you find an error, the SSA can correct it, but you will need documentation, typically your old W-2 forms or tax returns. The further back the error, the harder it is to prove. That is why reviewing your earnings record should not wait until retirement. Checking it every few years while you are still working gives you the best chance of catching and correcting mistakes before they permanently reduce the benefit you spent a lifetime earning. James eventually got his record corrected, but it cost him months of stress, documentation hunting, and back and forth with the agency. Do not wait. Log in today. Verify your record. Your future benefit depends on the accuracy of data you have never seen. Here is the hard truth that ties all 5 of these mistakes together. Social Security is the single most important financial asset most American retirees will ever have. For more than half of Americans over 65, Social Security provides the majority of their income. For about 1 in 4 seniors, it is virtually their only income. And yet the system that pays out this critical lifeline is built on decisions most people make only once, often in a rush, often without proper guidance, and often in ways that permanently reduce what they will receive. There is no appeal if you claimed too early and changed your mind, outside of a very narrow 12-month window after filing. There is no recovery if you worked past the earnings limit and lost months of payments you never got back. There is no refund for taxes you paid on benefits you did not know were taxable. The mistakes are permanent, or at least their consequences stretch across decades. But knowing they exist, understanding the rules, and taking even a few hours to review your own situation can make an enormous difference in how financially secure your retirement actually feels. Review your earnings record today at sa.gov. Understand your full retirement age before you file. Ask about spousal and survivor benefits if you are married or were ever married. Know the earnings limits if you plan to keep working. And set up tax withholding before the bill catches you off guard. These steps cost nothing except a little time, and they can protect thousands of dollars that belong to you. If this video helped you, if it confirmed something you suspected or told you something you genuinely did not know, please share it with a friend, a sibling, or a parent who is getting close to retirement. This information should not be hidden. It should be everywhere. And if you are not already subscribed to Retirement Today, please do that right now. We publish new videos every week on exactly these kinds of topics: Social Security strategies, Medicare decisions, tax planning in retirement, and how to protect the income you earned over a lifetime of work. Tap subscribe, turn on the bell, and we will see you in the next one. Your retirement is worth protecting. Let us help you do it.